the 7 levels of investing, and what each one unlocks. Most people think investing is about how much money you have, but it's really about how much you understand. At level 1, you own one boring fund, and that's it. By level 7, you're moving money into things most people don't even know exist. Each level hands you a whole new set of tools, if you're smart enough to use them. Starting with Level 1, the Rookie. This is Alex. He just got paid, and for once there's a little money left over after the bills. Instead of blowing it on something he'll forget about in a week, he opens his first investment account. The screen is almost insultingly simple. Just a balance, a search bar, and a green button that says buy. He moves in $500. It isn't much, but it's money he actually worked for, so watching it sit there feels strangely heavy. At this level, Alex isn't really investing for returns. He's buying understanding. So he does the simplest possible thing and drops the whole 500 into one index fund that tracks the S&P 500, which is just a single fund that quietly owns a tiny sliver of 500 of the biggest companies in America all at once. That one fund is his entire portfolio, and then he watches. Some weeks it drifts up, some weeks it dips, but the swings stay small enough that they never scare him. And that's exactly the point of this stage. This is where the one idea everything else is built on finally clicks for him. When you own a slice of the market, you own a slice of every business inside it. You're not betting on a price. You're betting that the whole economy keeps showing up to work. The returns here are almost a joke. On $500, an incredible year might hand Alex $40, which is roughly one decent pizza. But the $40 was never the prize. People at this level usually earn under $50,000 a year. Students, early career workers, anyone with far more time than money. Here's where Alex gets stuck, and it's the same place most beginners stall out for years. The trap isn't picking the wrong fund. It's that investing still feels like a thing he does only when there's spare cash lying around, which means most months he does nothing at all. The fix is almost embarrassingly boring, and the people who never learn it stay frozen on this exact rung for the rest of their lives. Level 2, the diversifier. Many funds, a few stocks, and one rule: never all crash together. Meet George. He's a couple of years into a real job now, the kind with a salary and a commute he loves to complain about. And so far, he's been investing like Alex, whenever the mood strikes. Then he learns the one habit that changes everything, and it has nothing to do with being smart. He stops investing when it feels right, and starts investing on a schedule, the same amount every single month, automatically, whether the market is green or bleeding red. Maybe it's $500. Maybe 1,000. The exact number matters far less than the fact that it never stops. This is where George stops owning one thing and starts building an actual portfolio. His money spreads out. The broad S&P 500 fund stays at the center, and around it he adds a sector or two he believes in, maybe technology or healthcare, plus a couple of individual companies he understands well. And he finally learns what diversification really means, because it isn't just owning a big pile of stuff. It's owning things that don't all fall on the same bad day. So when one of them drops, another one is busy holding him up. Then comes his first real test. The market doesn't dip a polite 2%. It falls 10, 15, sometimes more. And George's balance shrinks while every cell in his body screams at him to sell. His gut, it turns out, is a spectacularly bad portfolio manager. But he doesn't sell, because he's just learned the difference between volatility and risk. Volatility is only the market breathing in and out. Risk is panicking at the bottom and turning a temporary dip into a permanent loss. So he keeps buying straight through the fear, and because he's putting in the same dollar amount every month, he automatically scoops up more shares when they're cheap and fewer when they're pricey. That trick is called dollar cost averaging, and it does the work quietly while he sleeps. George's portfolio climbs from a few thousand into the tens of thousands. The gains are still small in raw dollars, but his behavior isn't random anymore. It's a system. People at this stage usually earn between $50,000 and $100,000 a year, solid middle income, the backbone of the entire market. The wall that traps people here is purely emotional. One ugly crash, one bad moment, and they panic sell everything they own at the worst possible time, then swear off investing for a decade. George's escape is to make the decision once and then hand it to a machine. He automates the monthly buy so his discipline runs on autopilot and his panic never gets a vote. Then one day, he checks his account and a single ordinary market swing has moved more money than he earns in a week. That's the signal. because at the next level, something flips that he can never unsee. His money starts earning more than he does. That's level 3. Stocks and bonds balanced on purpose. This is Priya, and she just crossed the milestone everyone underestimates. Her first $100,000. There's a reason it's the hardest one to reach, because once she's past it, the whole game quietly changes. A 1% move used to be pocket change for her. Now it's $1,000 in a single day. A strong year can add $8,000 to $12,000 to her account without her putting in a single extra cent. For the first time, her money is working harder than she is, because her gains have started earning gains of their own. That snowball has a name. It's called compounding. And this is the level where Priya finally feels it instead of just reading about it. She stops buying things at random and sets a target mix, what the pros call an allocation, maybe 70% in stocks for growth, 20% in bonds for stability, and 10% in cash for sleeping at night. When stocks run hot and swell into too big a share, she sells a little off the top, and when they crash and shrink, she buys more. That move is called rebalancing, and it feels completely backwards, like benching your best player right after he scores. But it's the trick that forces her to buy low and sell high without ever having to guess where the market is headed. Priya also starts thinking in something called risk-adjusted returns, which is a fancy way of saying she stops asking only how much did I make and starts asking how much stress did I swallow to make it. A crash stops feeling like the end of the world and starts feeling like a clearance sale. She gets into the tax game too, holding her investments longer than a year so the profit gets taxed at the lower long-term rate instead of the same brutal rate as her paycheck. People at this level often earn $100,000 to $200,000 a year. The quiet upper middle class who get rich slowly and almost never blow themselves up. The trap here is sneakier than fear. It's boredom and overconfidence. The portfolio is finally big enough to feel exciting. So Priya gets the itch to tinker, to chase a hot stock, to abandon the boring plan that's actually working. Her way out is discipline with a calendar. She rebalances on a fixed schedule and otherwise leaves the thing alone, letting time and compounding do the heavy lifting. But here's what changes next. Tools they reach for next look nothing like anything Priya has touched so far. Level 4, the optimizer. Real estate, alternatives, and the tax game. This is Daniel, and his portfolio now sits somewhere between $250,000 and $1 million. At this size, tiny tweaks turn into real money. Squeezing out an extra 2% isn't a rounding error anymore. It's $5,000 to $20,000 a year. So Daniel stops thinking like a saver and starts thinking like an engineer. He reaches past plain stocks and bonds. He adds real estate, usually through funds, so he gets the income without ever being the guy unclogging a tenant's toilet at 2 in the morning. He adds what the industry calls alternatives, things like commodities or private deals that march to their own rhythm. So when the stock market gets hammered, part of his money barely flinches, and he gets ruthless about taxes. He tucks his most heavily traded investments inside retirement accounts where the taxman can't pick at them every year, and keeps his long-term holdings in regular accounts where they're taxed far more gently. He even sells his losing positions on purpose to cancel out the taxes owed on his winners. That move is called tax loss harvesting, and most people go their entire lives never knowing it exists. The question Daniel asks himself flips too. He stops obsessing over how much he can make and starts asking how much he could lose, and how likely that loss really is. Because at this size, dodging one big disaster matters just as much as landing one big win. A 50% loss needs a 100% gain just to crawl back to even, and that ugly little fact finally scares him exactly the right amount. People here usually sit in the top 10% of earners, often pulling $200,000 to $400,000 a year. The danger at this level is a quiet one. It's complexity. Daniel now juggles so many accounts, funds, and clever tax moves that the whole thing can turn into a tangled mess he only half understands. And confusion is exactly where expensive mistakes love to hide. His escape is to simplify on purpose. Write down a clear job for every dollar, or hire one good advisor whose only task is keeping the machine clean. And then his money crosses a line that has nothing to do with how clever he is. It's a legal line, written into the law itself. And crossing it swings open an entire class of investments that ordinary people are flatly banned from touching. Level 5, the insider. Private companies the public is banned from touching. Meet Sophia. She just crossed $1 million in investable money, and the system officially reclassifies her. This isn't a vibe or a feeling. It's written into the law. In the United States, you become what's called an accredited investor the moment your net worth passes $1 million, not counting the house you live in, or once you earn more than $200,000 a year on your own, $300,000 with a spouse, for 2 straight years. Sophia hits the mark, and the velvet rope finally drops. The law now officially trusts her to lose money in far more interesting ways. Now she can buy into private companies before they ever reach the public stock market, the kind of deals that used to be reserved for the rich and the connected. There's private equity, which means buying whole slices of private businesses. There's venture capital, which means betting on startups before anyone outside the room has heard of them. There are big real estate projects that pull a group of investors together. None of these trade on a public exchange. It reaches Sophia through private networks, advisors, and banks, the sort of rooms most people never get invited into. The catch is very real. This money often gets locked away for 5 to 10 years, paid back slowly instead of whenever she feels like cashing out. So Sophia starts judging deals on things she never used to think about. Who is actually running this? How it's structured? What the return really looks like after everyone in the chain takes their cut in fees. She brings in private bankers and tax specialists, not to make the call for her, but to keep the whole machine running clean and honest. People at this level usually earn a few $100,000 a year and up, the top few percent of households in the entire country. And here the challenge changes shape completely. Sophia's money is now locked into deals she can't touch for 5 or 10 years, which means her biggest risk is running short on cash while sitting on paper millions. The skill that matters most is no longer finding good investments. It's patience and the planning that keeps her from ever being forced to sell early. Her way through is to hold a healthy reserve of liquid money on the side and only lock up what she truly won't need. Because at the next level, she stops being a person with a portfolio and starts running her money like a full-blown company. Level 6, the operator. A portfolio run like a business, across every asset class. This is Marcus, and his capital has pushed into the $10 to $100 million range, which means investing has stopped being something he does on the side. It's the job now. At this size, the percentages get heavy fast. A 5% year now means $500,000 to $5 million, made or lost while he sleeps. The kind of swing most people would happily retire on. Every decision carries real weight. Push past $5 million in investments and Marcus trips yet another legal line, becoming what's called a qualified purchaser, which unlocks an even more exclusive tier of funds that most everyday millionaires still can't get near. And his portfolio now has a clear job for every single piece, with public stocks carrying the growth, private equity chasing the big upside, real estate paying steady income, and bonds holding everything together when markets wobble. Nothing in it is sitting there by accident. At this point, Marcus sets up a family office, which is basically a small private company whose entire purpose on earth is to run his money, handle his taxes, and keep the whole operation organized. He starts grading himself like a professional, measuring his returns against benchmarks like the S&P 500 to check whether he's actually beating the simple option a complete beginner could have bought, and tracking how every private deal performs. And his whole mindset shifts. Protecting the money becomes just as important as growing it, because a serious loss at this scale can take years to dig back out of. These people sit in the top 10th of 1%. They barely have a salary anymore in any normal sense, because the money now earns far more than they ever could with their own 2 hands. The trap at this level inverts everything that came before. For 5 straight levels, the danger was doing too little. Now the danger is doing too much, getting seduced into complicated deals and constant activity when the boring, well-built portfolio was already winning. Marcus's discipline is to stay patient and let the structure do its work, treating preservation as the main job rather than a footnote. And as his money keeps compounding, his decisions slowly stop being personal at all. They start quietly shaping where money flows for everyone else. That's the final level. Level 7, the architect. You don't pick investments, you direct capital. This is Eleanor, though at this level, the person almost disappears behind the institution. She moves hundreds of millions, sometimes billions, through a fund, a family office, or an endowment. She doesn't really pick investments anymore. She directs capital. The questions in front of her are enormous, like how much should flow into public markets versus private, how much into credit, into real estate, into entire strategies at once. Eleanor invests through other managers as much as she invests for herself. She backs hedge funds, private equity firms, and venture funds, judging each one on its track record and on whether their incentives truly line up with hers, so they only win big when she does. Before a single dollar moves, the homework is staggering, checking every number and every claim, because one wrong allocation can cost hundreds of millions. Even getting out becomes its own strategy. That's liquidity, how quickly an investment can be turned back into cash. And at her size, she can't sell fast without the price moving against her. So everything is planned over years, not days. This is where capital stops following the market and starts bending it. A single allocation from Eleanor can keep a company alive, fund an entire industry, or drag a brand new strategy into the mainstream. When she commits, the other giants notice, and they follow her in. There's no salary worth mentioning at this level. Players like Eleanor control more money than most companies are even worth, and the real challenge is no longer returns at all. It's responsibility, because every move she makes ripples outward into jobs, industries, and entire markets, and a single careless decision can wreck far more than her own balance sheet. They sit in the top 100th of 1% and far beyond, because at this size, money doesn't join the market, it moves it. And that's the whole ladder. The same $500 Alex started with and the $500 million Eleanor directs were always playing the exact same game. The only thing that ever truly changed was what each level allowed the person holding it to do. So here's the real takeaway. Every level is locked behind money, but what money actually buys you is access. Access to better investments, better information, and better timing. The brutal truth is that hardly anyone clears level 2, and not because they can't afford to. They quit, or they panic at the worst possible moment and sell everything they own. The people who climb don't pull off any magic, they just start early. They hold on through the crashes, and they let time do the heavy lifting that no amount of clever stock picking ever could. Wherever you're standing on this ladder right now, the next rung is closer than it looks.